So today, we will be discussing the three major financial statements of nonprofits: income statement, balance sheet, and cash flow statement. An income statement provides the following information for the firm over a specific period of time: revenues earned, expenses incurred, and profits earned. The balance sheet contains information as of the date of its preparation of that following information: assets, everything that values the company and what it owns; liabilities, those would be the company's debts, stockholders' equity, the money invested by the company's owners; and then basic financial statements. So cash flow. Cash flow statement, it reports the cash received and cash spent by the firm over a specific period of time, usually the quarter of a year or a full year. As we dig a little bit deeper into the income statement, an income statement, also called a profit and loss statement, is measured by the amounts of profits generated by a firm over the time period, usually a year or a quarter. It can be expressed as follows: revenues or expenses, which equal profits. Revenues equal sales. An income statement will contain the following: revenues, cost of goods sold, gross profit, operating expenses, net operating income, interest expense, earning before taxes, income taxes, and net income. The balance sheet is a snapshot of the firm's financial position on a specific date. It's defined by the following equation: total assets and total shareholders' equity. Balance sheet includes total liabilities, total shareholders' equity, and total assets. The GAAP requires that the firm report assets using the historical costs. Cash and assets held for sale, such as marketable securities, are an exception to the rule. These assets are reported using the lower of their cost or current market value. Assets whose value is expected to decline over time, such as equipment, are adjusted downward periodically by depreciating the historical cost. Balance sheet reports the book value equal to historical costs less the accumulated depreciation. Generally, the rule of thumb is the book value is not equal to the current market value of the firm's assets. Last but not least is the cash flow statement. The cash flow statement is a report that firms use to explain changes in their cash balances over a specific period of time by identifying all of the sources of cash, uses of cash for that period. Source of cash is any activity that brings cash into the firm. Use of cash is any activity that causes cash to leave the firm. For example, if there is any sort of tax that is incurred,